Hi everyone, welcome back to the channel. In this video, I want to talk about the FAANG stocks and if they are a good buy right now. Now, everyone knows about these stocks. These high-flying tech stocks are the most popular stocks in the entire market, and over the past few years, they've swelled up to enormous market cap. So in this video, what I want to show you is how the list of the largest companies in terms of market cap have changed over time, and then I want to show you some of the risks that are coming for these tech companies that I don't think the market is concerned enough about. So this is a visual representation of the S&P 500, and the S&P 500 is a market cap weighted index. So the larger a company is, the larger of a percentage it takes up in the index. And so as you can see, what that leads to is an index being skewed in the direction of those larger market cap companies. And of course, lately that's been all the tech companies. So if you look right now, you have these 5 companies, Apple, Amazon, Alphabet, which is Google, Microsoft, and Facebook. They're making up almost half of the S&P 500. So when you invest in the S&P 500 right now, for every dollar you put in, 50 cents is only going to these 5 companies. So that is also something to keep in mind when you're investing in a market cap weighted index. You should really take a look to see what companies you're really investing the most into. Now we're going to take a look at how the largest market cap companies have changed over time, because this is a lot of things that especially new investors get caught up in, where they see these largest companies out there and they think these are no-lose investments. These are the best companies out here. That's why they're the largest companies in the world. And because of that, I should be comfortable investing into these companies because they will continue to provide these outsized returns. And the history of the largest companies in the past show that that's not necessarily true. Where we can take a look at the top 10 companies during the dot-com bubble in 1999. You had companies like Microsoft, GE, Cisco, Exxon, Walmart, Intel, NTT, a technology company, Nokia, and BP. And back in 1999, these were the most popular companies in the stock market, where everyone was investing into these companies thinking they were going to be the future and were going to provide the same returns that they had in the past to get to the point where they are one of the largest companies. And obviously, looking back on it, that thinking, Microsoft is still in the list of one of the top companies, but every other company on this list has fallen off. GE is nowhere even close to where it was in 1999. Same with Cisco, Exxon, Walmart, Intel. They're all still good companies, but a lot of these companies that were in the top 10 in 1999 still haven't even gone on to make a new all-time high, right? That was the top of these stocks, and they're still below that 20 years later. So if you take a look 10 years after this, we'll go to the financial crisis in 2009, and this was when oil stocks were more in favor, where you had PetroChina, number one, then you had Exxon, and then you had a number of other foreign oil companies, and then you had Shell, and then Microsoft, Walmart, and Johnson & Johnson were in there. But this just shows how the perception in the marketplace can change, where you can swing from, all tech stocks being the largest companies in the world. Now we're swinging all the way to foreign oil companies being in favor in the market. And again, if you look at the top 10 companies today, very few of these are still on the list. Microsoft has been the one consistent company that's been one of the largest companies for the past 20 years. But besides that, all of these other companies have fallen off. Then you can take a look in 2014. This is really when tech started coming in heavy, where we saw Apple, Alphabet, Microsoft. And then obviously 2019 is all the big tech stocks, where you had the vast majority of the companies being technology companies. And so the question is, where do we go from here? We know now that the tech stocks, just like in 1999, are the most popular and the largest companies in the stock market. So does that mean these returns are going to continue? So now we can take a look at this in closer detail. This is a report from the advisor Symposium by Rob Arnott. He is a well-known investor, and so he created this very informative report on the largest companies in the market and how they perform following over the next couple of decades. So I'll leave the link to this report in the description if you want to read the whole thing. But here, just to give a picture of how expensive the FAANG stocks are, that's FAANG plus Microsoft. Just this group of 6 stocks is larger than most companies. You have the United States, Japan, and then these 6 stocks are larger than the entire stock markets of China, UK, France, Germany, all the way down. And then if we take a look at even just within the United States, where these 6 stocks would be the 3rd largest sector in the entire stock market under financial and healthcare. So obviously these are giant mega cap companies that just these 6 stocks are larger than, the entire economies of other countries out there. Now, if we take a look at this next slide, the thing to notice and what I showed you in that last page is that the top stocks are very inconsistent. Every few years, the list looks almost completely different than a few years before that. And that just shows to how much investor sentiment can change in such a short period of time, where you see all of this one category of stocks that's very popular and loved by the market, and just a couple of years later that can completely shift. So this shows various years from the 1980 to just last year, and it's color coded so it's easy to see. If a company is in red, it means it drops off the list next year, and if it's yellow, it means it just got added and then it drops from the list. So just from looking at this chart, in any given year, it looks like almost half of the companies will drop off. And so the question is, what does this mean for someone that wants to buy a company that is in the group of one of the 10 largest market cap companies? And the answer to the question of why this list changes so rapidly is because these stocks tend to underperform after making the list of one of the top 10 largest companies, right? Where if you invested in this hypothetical portfolio where each year you invested in the top 10 largest companies in the world, this type of portfolio would only outpace the global cap weighted stock market only 5% of the time over the last 30 years, and it underperformed by 10% per year, right? And then the next slide asks, do you want to own a portfolio in which the largest holding has a 95% likelihood of underperforming over the next 10 years? Obviously, no, you don't. And then this report goes into different types of portfolios out there and how you can mitigate this risk. But overall, I think this is a trap that many investors, especially new investors, fall into. And to get out of thinking this way, there is a specific way you have to think. And I think a big reason that a lot of investors fall into this trap is because they are using first level thinking. Now, these terms, first and second level thinking, were developed by Howard Marks. He is a very famous investor who's written a number of books and reports and memos that are very popular out there. And so this is a passage from one of his memos. Again, I'll put a link to this in the description, where he talks about the difference between first level thinking and second level thinking, where basically the argument is, if you invest in the same things that everyone else invests into in the stock market, you're going to get average returns by definition. If you're investing in the same thing as everyone else, you're going to get the same results as everyone else. So what you have to do is you have to try to distance yourself from the masses, from the general investing population, and think on a different level than them, and that is what's labeled second level thinking. All right, this is a passage here that covers it. Remember, your goal in investing isn't to earn average returns. You want to do better than average. Thus, your thinking has to be better than that of others, more powerful, and at a higher level. Since others may be smart, well-informed, highly computerized, you must find an edge you don't have, and you can do that by thinking of something they haven't thought of, see things they miss, or bring insight they don't possess. And then he gives some examples. The first one I think is very telling, where a first level thinking person would say, this is a good company, so let's buy the stock. A second level thinking person would say, it's a good company, but everyone thinks it's a great company, and it's not. So the stock's overrated and overpriced. And so I think this is the trap that a lot of investors fall into. They say a company like Apple, like Google, like Facebook, and they say it's a good company, therefore it is a good investment and I should buy the stock, without giving any thought to the type of valuation or what the future projections for the company look like. And so just looking back at the top performing companies in the past 10 to 20 years, we can see that that strategy doesn't work out very well. And so I'm not trying to say that these aren't great companies. Obviously, Apple, Facebook, Google, they're all great companies that are some of the most efficient companies out there that can just gush cash every year. But the thing is, I try to take a second level thinking view that says, yes, it is a good company, but the problem is the entire market thinks that way too. And so many people have rushed into these companies that they're now the largest in the world. So the question is, it's a good company, but does that make it a good investment? And so if I had to answer that today at these valuations, I would argue that a lot of the tech companies aren't priced at valuations that would suggest that they are great returns going forward. That being said, I don't know what's going to happen. Obviously, these companies can continue outperforming, but it is just something to think about. Okay, and so just like how a lot of investors are super excited about the upside of these companies, I think a lot of the risks for these big tech stocks are being downplayed by the market. And a big one that I think may have a real impact on these tech companies in the near term is governments cracking down on these tech companies, where this is an article just from today, October 12th, and it says global watchdog proposes tax overhaul for big tech. So over the past few years, these big tech companies have been under attack for, apparently not paying their fair share of taxes. And so I think this is a potential big risk that if the legislation changes that now forces these companies to pay higher in taxes, Facebook that has 40% profit margins, is that type of efficiency still going to be here after their taxes go up by 3 or 4 times? So we can take a look at this article. A global economic watchdog on Monday proposed an overhaul of international tax rules to make sure big tech companies pay their dues, and warned that a failure to do this would make the economic recovery even worse. And then it goes on talking about the support for this. So I think this is a pretty big risk over the next few years for these big tech companies, they're now being specifically targeted by politicians. And I don't even think it's one side or the other at this point. I think at this point, most people involved in politics, have come to an agreement that these tech companies should be paying more taxes. And so whether you agree with that or not, it's obvious that the people that are in power right now will be starting to go after these tech companies. And like I said, if the taxes do go up for them, their margins will go down, their earnings will go down. And that is just one possible catalyst that would create a scenario where these tech companies do in fact underperform over the next decade. So that's really what I wanted to touch on in this video. This is by no means a prediction of me saying, all the tech stocks are going to crash in a year or something like that. But I'm just saying to keep an open mind and try to use second level thinking as much as you can, right? There can be a company that is one of the best companies out there, but if everyone thinks that and it's priced like it, then you have to think, will the returns still be what I think they will be? So that's it for this video. Let me know if you agree with this analysis down in the comments. I'm curious what you have to think about the future of these FAANG stocks and these big tech stocks, and we will see how this plays out over the next couple of years. So if you found something of value from this video, hit the like button as it helps out my channel a ton, and subscribe to the channel if you haven't already, and click the bell icon to get notified whenever I upload a new video. And that's it for now, so I'll see you next time.